In today's video, we're discussing the US's most recent inflation data and what you should do when interest rates start to go up. The definitive guide on how to manage your credit, product, penalty, price in that order. It's never been more important to get your mortgage right. All right, welcome back. In today's video, we're going to discuss all the US inflation data that has come out obviously prior to the Canadian data. And we're also going to discuss what you should do when interest rates do start going up, especially if you have a variable or a fixed rate mortgage for that matter. But before we get into it, do me that favor, hit that subscribe button, hit that notification bell, and please hit that like button so more people like you can see this video. And don't forget about our race to 25,000 subscribers, where when we hit 25,000 subscribers, we're going to give away $5,000 to one lucky winner, but you have to be subscribed to win. So go ahead, click that subscribe button. It's free, it's easy, and it's definitely worth it. Oh, and by the way, don't forget about our secrets to getting the lowest interest rate course. If you're watching this video, it probably means that you are in the market for a mortgage or you already have one. And if you already have one, there's probably a pretty good chance that in the next little while, you're going to need to know everything you can about how to get a lower rate, because there's going to be all kinds of opportunities for you to switch lenders and get a lower rate than what is otherwise being offered. So if you are in the market for a mortgage and you want to do it all by yourself, you don't want Mortgage 360 to come in and be the white knight for you. You want to get the information, be really well informed, know exactly how to negotiate with a broker, a bank, and how much profit margin exactly you can negotiate into those deals, and how to get a better rate on renewal and all of those things. Well, you can go to ratesecrets.ca and get that course. It is priced incredibly low. Most people who take it get between 10 and 50 times their money back, and some really, really smart people get 10 times their money back automatically by getting a $1,000 certificate for Mortgage 360 when they choose Mortgage 360 for their mortgage. So it's pretty much easy, simple money. So again, ratesecrets.ca, and let's get into the video and discuss what is going on with inflation. So I'm going to jump you straight into my screen here and just get straight to the news, because in the US right now, it's not good. US inflation hits a 40-year high going back to 1982 of 7%. This is the highest inflation has been going back 4 decades, which is an insane number. And, you know, we saw this creeping up in the fall, getting worse and worse and worse. We saw Jerome Powell basically come out and say, maybe it's not transitory. They're getting more hawkish on inflation. And we have some economists predicting that the Federal Reserve could move as soon as this month. And we also have some Canadian economists predicting from JP Morgan here that the Bank of Canada could hike rates this month as well. Now, I don't think it's necessarily likely that they're going to increase interest rates on January 26th. It's possible, and they could do it and they could surprise the market, but they've been very clear about the fact that they want to communicate what's going on, and they want to make sure that Canadians are well aware of the changes before they happen. So I don't necessarily think this could happen. It could be a surprise if inflation numbers come back in the middle of this month significantly higher than what was expected. It is a possibility. It could be that they move up that timeline from March to January, but realistically, I think we probably still get another month or two at low interest rates. Now, that again is a prediction. Anything can happen. And, you know, it's going to be really interesting to see how the first part of this year goes, because it's very clear that inflation is here. It's very clear that we are seeing higher prices for things. And it's very clear that the majority of people feel like inflation is a problem and that the Bank of Canada and the Federal Reserve need to act. In fact, RBC, actually, if you take a look at the bottom of this article here, one of the other videos that comes up is RBC's CEO calls for rapid action to tame inflation. So you've got economists, you've got banks basically saying something needs to happen, something needs to give, because inflation like this can't go on forever. Now, what's really interesting though is that while you have a lot of people really fearful of inflation right now, you've still got some pretty prominent investors that are saying that they aren't necessarily worried about inflation. So this is Cathie Wood. She was named the 2020 Trader of the Year by Bloomberg. She made some really big forecasts. She predicted that Tesla would go up to $4,000 just after it had dropped by 29%. And she was right. Nobody thought that it was going to go anywhere close to that. Everyone thought she was crazy. She was able to call the market on that. And what she's saying about the market right now is that she isn't necessarily worried about inflation. She thinks that the Federal Reserve is being hawkish and that they are talking about increasing interest rates because they have to. She called it jawboning. And she's saying that they have to be hawkish in order to encourage people not to buy more things and hoard things and so on and so forth. And that the real problem and the real thing that they're expecting is deflation in the future. So really interesting contrary comments coming from from the person who was named the Trader of the Year by Bloomberg in 2020. And it gets real interesting because if you go and you take a look at her website, she's the CEO and Chief Investment Officer of ARK Investments, which is a disruptive technology investor. They have some ETFs, really cool company. And they put out blogs, and this one's from December 17th, and it has some really interesting points. Now, I'm not making a case for inflation or against inflation. I'm not making a case for interest rates going up or not going up. But what I am trying to do is contrast the information that we're seeing in the mainstream media with some other thought leaders. And this is really, really interesting here because she talks in this article about the fact that the inflation rate in November went up to 6.8. However, at the same time, the US consumer savings rate dropped below 8%. And this is in addition to the fact that in 2020 and 2021, we saw a significant amount of people hoarding goods because they thought that they were never going to be able to get things like toilet paper ever again. And she's basically looking at the fact that there is all these hoarded goods along with lower savings rates. And what that essentially means is that there's going to be less upward demand going forward and less buying pressure. So she's making a case for the fact that inflation could start to teeter out in 2022 as people start to use those goods that they've hoarded, as supply chain issues start to work themselves out, as all the incentives that have been going to people in order to be able to spend more money start to teeter out, and essentially as spending and savings goes down. And then she talks a little bit about the fact that the real issue could be talking about preventing the next recession going into 2022. And we saw Elon Musk reflecting the same sort of commentary in the last week or so. So really interesting that she still believes that supply chain issues are the major issues, and she sees potentially deflation or recession coming at the end of 2022 as something that they are planning into their investment decisions. So, when you take a look at this and you start thinking about all this data and you go, okay, well, let's say Kathy Wood is right. Let's say there's less inflation going through the first and second quarter of 2022, and then all of a sudden the word recession starts to rear its ugly head in the end of 2022, and they start having to do things like pull back the monetary stimulus and pull back the interest rate increases. Well, what it means is that you could end up in a scenario where we see lower rates for longer. Or if she's wrong, you could have the exact opposite thing happen. Now, keep in mind, this is the person that when everyone was selling Tesla, because it went down 29% in a very short period of time, she was saying it's still going to go up in value. It's going to go up to $4,000. And she was right. So there's a good chance that she could be right in this scenario. There's also a really good chance that she could be completely wrong. Now, the reason why I discuss all this and I talk about all of this is because I always bring things back to what it means for your mortgage. And there's two types of borrowers out there right now. There's the type of borrower who has chosen a variable rate with a pretty significant amount of savings over the last year or two. And there's those who have picked 5-year fixed mortgages. Now, if you have a 5-year fixed mortgage and you are paying 2.79%, there are opportunities for you to get a significantly lower interest rate right now by going into a variable or a shorter term interest rate. And as time passes here, I'm going to suggest that you're probably going to see shorter term interest rates get lower and lower on mortgages. And it's something to watch into 2022 and 2023, where if you've got 2 or 3 years left on your 5-year fixed and you can get into a 2 or 3 year mortgage for significantly lower price, that's an action that you want to take. But more importantly is the variable rate borrowers here, because the question is, what do you do when they start raising interest rates? Because the immediate thing that's going to happen as soon as we get a notification that rates are going to go up is everyone's going to call Nolan and say, hey, what do I do? Should I lock in? And I'm going to give you the answer real quickly as to how you assess this. Now, first and foremost, if it really, really scares you, then you should probably lock in and just get it done and don't worry about it. But the reality of it here is there's a simple math equation that you should be looking at when it comes to whether or not you should be locking in. And that's simply looking at the spread between the rate that you're paying and the rate that it's going up to and what you can get a fixed rate mortgage for, because there's a high likelihood that when interest rates go up, they go from 1.45% to 1.7%. And what you're probably going to find is that the comparable 5-year fix that you could lock into is probably going to be priced at 2.7 or 2.8%. So you're going to have to lock into a 1% higher interest rate, which goes back to the original conversation around choosing variable versus fixed, which is what is the dollar value per month of locking in the interest rate? And then are you willing to pay that amount of money for the security of having a fixed rate mortgage, and then it's just basically a value decision at that point. But there's other mortgages that you have to look at as well, because typically when you're looking at a variable rate and you're looking at locking in, you have to lock in for a term that's longer than the amount of time remaining on your mortgage. So in other words, if you have 2 years remaining on your mortgage, you have to lock into a term of 2 years or longer, which means you may have an opportunity to take a 2-year term at a really good rate that's pretty comparable. And what you want to look for is you want to look for those rates to be very similar to the rate that you're already paying. And by the way, let's say there's a really good 1-year rate special out there and you've got 2 years left. You can always choose to pay the penalty on your variable rate mortgage and then switch to a different lender and lock into that 1-year lower term rate. So the key takeaway here and what I want to get across is that when you're looking at locking in, what you're trying to do is, if you're timing it perfectly, you're trying to lock into short-term interest rates that are very similar to the rate that you're already paying. You don't want to go and jump into a 5-year fix that's priced 1 or 1.5% higher than the rate that you're paying, because if you did, it essentially eliminates the whole reason why you went into a variable rate mortgage to begin with. So the main thing here is that when interest rates do start to go up, expect that they're going to go up. They're probably going to go up by 1% over a year or two, might even go up more than that, but expect also that at some point they're probably going to come back down. And the question will be, do you want to ride the wave of them going up and coming back down and lock in some more savings as a result? Or do you want to just have that peace of mind at night? And really what it's going to come down to each and every time you look at this, not just choosing a variable versus a fixed, but also when you're looking at locking in, is do I want to take the risk? And is the cost difference enough to encourage me to do so or not do so? So when interest rates start to go up, be calm, think about it calmly, watch these videos, get as much information as you can, and then simply determine the difference in the interest cost between what you could lock in and what you're at now, and then simply determine if that is something that you want to deal with. By the way, the easiest way to see what rates are is download the My Mortgage Toolbox app linked in the description below, and you can go into that app anytime and get a pretty good idea what interest rates are. By the way, I don't update those. Those are all automated from Dominion Lending Centers. Oftentimes there are better rates out there, so use it as an example, but not as an actual quote for what rates are, because there is opportunity often to get better rates. But you'll be able to follow along and see what's happening by downloading that app. So if you found this video useful, do me that favor, hit that subscribe button, hit that notification bell. Please hit that like button so more people like you can see this video. And don't forget about our race to 25,000 subscribers. We'll see you on the very next one. Cheers.